Before we get started, I just want to make a reminder to everybody that the information discussed today is not to be interpreted or construed as investment advice. Everyone's financial situation, goals, and objectives are different. Please consult investment advice.
The dirty secret is that no one's ever going to get paid back.
People have the shortest memories when it comes to investment.
We just got to get Keith into Bitcoin.
Hey, there's a bubble. Welcome back to the Loonie Hour, episode 32. As always, joined by the three amigos. We got Rich Diaz of Acorn Macro Consulting, and we got everyone's favorite boomer in his Patagucci jacket today, Keith Dicker of IceCap Asset Management. Welcome back to the show, gentlemen. This is my favorite part of the week. Just want to thank everyone for coming out to the live event in Vancouver. We were blown away. A couple hundred people, sold out barn. The drinks were flowing. It was a great time. We're just amazed that people kind of flew all across the country to fly into Vancouver to come see us, chat for a couple hours. It's very humbling. We want to thank you again. We'll definitely do more live events. We're kind of thinking maybe we do like an annual Loonie Hour live and kind of, figure out different locations maybe each year or something like that. So looking forward to that. I don't know if you guys had, before we get into this week's show, if you guys had any initial comments on that, the event there. Keith?
Rich?
Keith. Yeah.
Oh, me? I'm just really grateful that everybody was so engaged and so willing to have such honest and open dialogue about difficult and, some contentious and, maybe some unacceptable views were shared. And I think it was done in good faith. And I think I learned a lot. And I'm just really humbled, really. I think that was it. And I feel now I have a responsibility to keep pumping out some good content and to share and to learn and that was it. Just wanted to say thank you. So thanks for everybody who showed up, and we'll keep going. Keith?
I loved how Rich was dressed for a date. I love that part. It was really good. Yep. No, but seriously, for everyone, thank you for everyone for coming out. It was a lot of fun, as Steve and Rich just said as well. It's very casual, great conversations. So when we do this again, if you want to go to the next one, come on again. We'll get a bigger place. But if you weren't able to make it to the first one, just come over and it'll be a lot of fun. We don't know when we'll do it again, but we will. And, we're really looking forward to it. So there we go. Off we go.
By the way, we got some big news here. The Loonie Hour now has an official website that is launched publicly. So www.thelooniehour.ca. It's a great website. A couple of local Halifax gentlemen put it together. So extremely thankful for that. But let's kind of dive into this week's show. I'm kind of getting tired of, man. It feels like when we first started the show, we were like, well, we're going to talk about inflation. And like, here we are, 32 episodes in Canada's, CPI inflation just printed like another record. What is up? 6.8% year over year. I think it was the highest since the 1991
one or two. I can't remember. Yeah.
Yeah. But there was a bunch of metrics, obviously, that, had importance that were highest since the 1980s. So, I'm just kind of going through my notes here, but we had, so for example, inflation in Canada at 6.8%, shelter inflation was up 7.4% year over year. That was the largest increase since 1983. And then you have food inflation, which is extremely important and I think has societal and political implications. Food inflation running at 9.7%, at least at your grocery stores, running at 9.7%, the highest since 1981. So obviously putting the Bank of Canada in a very peculiar situation. But Rich, I'd love for you to unpack the data a little bit further. We were kind of joking on Twitter the other day because of, food inflation at 9.7%, but they had wasn't it like food at restaurants is only up like 6.5% or something?
Yeah. So the three categories, the three subcategories are fast food and takeout restaurants. Then it's like food from stores, and then table service restaurants. So fast food and takeout restaurants, it was up 6.7%, which is laughable here. I do not believe
insane.
that. The local shawarma place that I go is up 25%, right? It was 930 or for
somebody was commenting on Twitter the other day about chicken donair prices at their local.
Yeah, that's right. But it's just like, it's at least 30%. This idea that it's I mean, I don't know these people, what restaurants we need to find out. We need to go to Ottawa and figure out where these StatsCan guys go where they go to eat, because it's very cheap there. And then the other things was from stores it was like just basically just under 10%. And again, I do the grocery shopping in my family. For my family, and it's absurd. I mean, it's at least we're talking, I think it's like at least 30%. And then from table service restaurants, 6.5 again, who knows what these numbers are, but yeah, man. I think it's wild. I mean, I'm not saying I could do a better job, but I know a bad number when I see one.
Dining out is getting so expensive. Even Keith can't afford it anymore.
I think though with the guys at Stats Canada who are doing the inflation numbers, I think they're eating the white bread with mayo and bologna sandwiches. Yeah. I don't think they go out to eat
Tim Hortons chili.
But there's two things I really wanted to stress. One, which you touched on quickly, which is the shelter component. We've talked about this before, and shelter is the largest component of the CPI basket. Makes sense. Rent and mortgages and all that is usually people's largest outlay. That just continues to ratchet. Like, it's accelerating. So even though obviously it tracks rent and house prices somewhat, and we're seeing some softness in the housing market, which we'll talk about a little later. There's a lagged effect, obviously, and that shelter component is now contributing, 3% basically to the overall inflation number, which is just, or even so. Shelter was 7.4. So shelter, 7.4 times, 39 or 0.39, and then you get the contribution to core, and it's just an incredible number. And so this is one of the underlying reasons why I thought it wasn't going to be transitory, and it's playing out as sort of we expected. Thank goodness, or not thank goodness. I guess it's bad, but anyways. And then the other thing, I think, I'm going to hammer this one home on and on, because a couple of weeks ago, some of our politicians are starting to criticize the Bank of Canada. I think the most important technocrat in the country deserves scrutiny, at least as much as your favorite hockey team, if not more. And the idea that you cannot criticize what's going on there, I think, is wrong. The Bank of Canada years ago, rightly created three preferred measures of core inflation. They're based on one, the model estimate, one's trimmed mean, and I always forget the third one. But you can look them up. And these are meant to be the key. Well, they're literally called the three preferred measures of core inflation. There's loads and loads of papers that you can find online and on the website. And these measures continue to climb naturally and it's just so, the idea that they either didn't know that inflation wasn't transitory, or that, and then the fact that once it became obvious, again, according to their own preferred measures, the fact that they didn't raise rates, I think is just, it warrants some of the criticism, if not all the criticism that we've heard. But yeah, so the preferred measures are now 5, 4, and 3 respectively, and rising. And then the last thing, which is, I think, really important, which is actually good news maybe, on the inflation front, is something I track a lot, which is the producer price index. Actually just came out a few minutes ago. And that's, it leads core inflation by 9 months, and it's rolled over significantly. And so, we discussed this before. I think we are actually seeing the peak of this inflation impulse.
Okay, well, so that leads me to my next question. Is I want to ask you, because we've been chatting about this, and it seems like I will admittedly say I was a little bit early on the sort of peak inflation call. I mean, part of that was kind of the war in China just being stupid. But do you have like a particular? I mean, it's good. I'm not going to hold you to this, but do you have like a particular month? A quarter that yes, inflation will peak
afternoon on Thursday.
No, like, do you see that peaking out? Like, is it like next month? Is it like, I mean, we're getting really, really close.
Yes, we are. I promise to share this chart for the YouTube viewers on YouTube. I think by the end of the year. So my number is probably November, December. Will probably,
that long from a rate of change perspective.
Yeah. I mean, the chart listen, anyone who works with me and knows me knows that I don't like models. I think people fall in love with models, and, you know, and I can go on and on about why I think I don't like to rely on them. And so my model is just a very straightforward and simple relationship that has worked very, very well. It's core producer prices, X energy, and its year-on-year change has more or less predicted core inflation in Canada. Makes sense? If it takes time to feed through the most important commodity prices. It takes time to feed that through into other consumer products and the rest of your basket. It takes a while. 6 to 9 months. And so we've already seen the peak in producer prices in Canada. And so I think it'll take 6 to 9 months from now. And 6 to 9 months after May is November or December.
Oh, sorry. And then do you have the US peaking out earlier than Canada in your base case kind of thing?
I think it'll probably be around the same. I'd have to check. Yeah, it's probably around the same. I think the U.S. it might be earlier just as a function of having a much stronger currency, as we've seen. And then their producer price index has already started to come off.
Keith,
slightly.
do you want to chime in here?
Yeah, I mean, so a couple of things that is sort of in line, Rich, with market expectations for when central banks will peak. So those that are raising rates. So we're looking at, by the way, everyone, so June the 1st, the Bank of Canada is out. So another week and a half. So one more Loonie Hour episode before we can place our bets for what's going to happen.
Twinkie bets are on the line.
Yeah, right now it's pretty well locked in for 50 basis points coming up. So we'll see what you two guys get together with.
We're doing a prediction next episode, I think, huh?
Yeah, next episode is gonna be a lot of fun. But the other thing, because I think we talked about this 2 episodes ago, or maybe in Vancouver, I don't recall. And it's kind of funny because Rich and I have been going back and forth with this for a little bit, and is it happening? Is it not happening? But if you look at the comments from the American head of their central bank, is it last week? He's basically saying, yeah, the only way we can stop inflation or slow is by crushing the economy. He didn't say the word crushing, right? But it sounds a lot more dramatic when you say that. We're gonna crush it. But you'd crush the economy in a number of ways. And one way, it is the wealth effect. And I do believe it has an impact. And so with everything coming off hard now, that is going to affect the economy. So maybe when inflation is, we're peaking based on what you just shared with us, Rich, it might be when the lagging indicators from the economy. So whether we're looking at quarterly GDP growth or even monthly, ISM data and other spending data, maybe we are reaching that peak point, maybe Q3, Q4. And then central banks should roll over as well. I'm still under the expectation that if we get to that point without a significant crisis occurring beforehand, I'm going to be shocked, because I think things are just wound up so tight here all around the world. Whether it's the Europeans or in the US, or I think maybe in Asia as well. But by the way, I think the financial stress in the world, it's more acute in Asia, in Europe, as well as in China. I think those are the 2 markets, that could, really zip things around, which would affect Canadians. And that's one of the things that we keep talking about all the time. What could cause the Canadian marketplace to experience stress, or the Canadian banks to experience stress, which we have to talk about the banks in a few minutes, of course, Canadian banks. But I continue to expect it'll be, and what's the sign? You see something like how many days without an incident? You have one of those put up.
Yeah, it's like it's been 4 days without an injury. Is it on on a factory floor or what have you?
Oh, yeah. I'm gonna start one of those Twitter accounts. It's like all just tweets is like, just like, have we had a financial accident yet? No,
we can do that. But I think though that accident event, it will, for Canada, it will be triggered from outside of Canada, and I think that's what a lot of our listeners starting to appreciate about our conversations, that, we talk about things that are happening around the world, but everything is so interconnected these days that something from outside can affect us inside. I think that's the key thing to look at, right?
Which, yeah, we're gonna get into here shortly, because there's a whole bunch of
before we go on to that, I'm sorry, just a really quick one, because Keith said, we're waiting for a sort of a financial accident or some kind of crisis, likely from outside. I mean, haven't we sort of had one? I mean, I'm looking at it now. The Russell 2000, which is a US small cap index, is down 26%. NASDAQ 100 is down 26.9%. Bitcoin, God love us, is down, 52%. I mean, does that not count as far as a financial accident? You mean more something in the credit space, or how would you define that?
Yeah, I don't. Those market metrics are accurate, but those are financial markets, and like it or not, like nothing has broken. Like the market has gone down, right? Really,
I agree.
It happens, right? For my definition of a market accident, a major player in this space, they go under. So remember when like Home Capital Group got in trouble a few years ago in Canada, which was a bit of if that happened today, I bet you the contagion would be significant. At that time, I was just think of them with their underwriting skills. They were pushing the boat out, quite a bit. But for today, for example, it would be, again, if some country,
like a major hedge fund blowing up or something.
Yeah, because again, like you get the tentacles, reaching around everywhere, and like we'll feel it, and you won't know it. You only know it with hindsight. Say, yeah, that was the event. It's not nice when markets go down, but they happen all the time. And like I know a lot of people out there these days, they might be looking at some numbers with a negative sign in front of it. If you're Canadian or American or wherever, but again, nothing has broken yet. And by the way, I do think it's a real shame that bond investors, the most conservative investors across the country, they've been, corralled into these bond funds, over the years because it's safer than the stock market. And at the end of the day, maybe they're a little bit safer because, equities are down a bit, but, people have just been crushed in the bond world. And the industry is responsible for that. There's a big thing. By the way, it sort of leads into... I had a nice conversation with a guy earlier this week. Anyway, his name is Nick Archambault. He's a student there in the Ottawa area. He's asking me about, how to get into the industry and stuff like that. It's something maybe three of us can share our views on it, because I think a lot of people are trying to break into it or break out of it, maybe if you're on the other side. But what was really interesting, with the conversation, and what I love about, the younger generations today, my God, they're so smart, they're excited, they're enthusiastic, and they just want answers. How do we do it? How do we do it? And one thing that really came up from the conversation was that, again, I'm this is the way I lean, but I think it is a global macro world. The more you understand that, the better you'll be able to appreciate why markets are moving in a different direction. Plus, if you want to stand out against your competitors, people you're going up against in job interviews and stuff like that, if you're able to link, global macro stuff, whether it's interest rates, short end or long end, or inflation, or the effect of energy.
When you go for your interview at Mickey D's.
Yeah, maybe not, but you know what I mean? Like, even if you're able to do that, you're going to stand out. And then the question was, what do I learn about this? And I said, Twitter. Again, like there's no, but that's just the challenge today, right? Because you have to really go out there and find it, because you're not going to find it in a textbook or like in a bank mutual fund quarterly report and stuff like that. But do you guys get similar questions, over time?
Oh, well, I don't know. I mean, people always ask, where did you learn? It's like, I don't know, like just I'm an autodidact. Like there's so much like good information that you can like get for free and or pay to subscribe to. Like, I love Real Vision and all these different podcasts. Twitter, like you mentioned Twitter, like you can follow like the smartest people in finance on Twitter for free. And they also publish a lot of like free insights. I just think it's incredible. Like the ability to learn these. Are you eating a Twinkie?
Why?
Jesus.
I am. It's actually good. I haven't had one yet.
I bought, if FYI for everybody listening back home, I bought both these guys a box when they came here. So clearly you've taken that box home, and that's probably the last one left.
Well, I mean, just for me on the learning stuff, I think for me, I mean, my route was a bit more traditional, in the sense that I did finance and economics at McGill, and then I went and did my CFA. I applied to I applied to 100 jobs in 2008, and just literally almost 100 jobs. And just I ended up finding really my home at a company called BCA Research. I guess I'm not sure they deserve a plug, but anyways. But the thing that only sort of take you so far. I think what you need to do is, for me, what's always been really, really helpful is learning history. And I tell Nathan, my analyst, you have to understand, the Cuban Missile Crisis. You need to understand the oil embargo in the 70s. You need to understand inflation and violence in the 80s. You need to understand the German reunification, and you need to understand Russian history, and you need to understand Japanese history, and why China hates South Korea, and why South Korea hates Japan. And I think it's, you have to be good in this game. I think you really need to not just stick to quantitative methods and accounting, which are obviously very, very important. You need to understand the human condition. And for me, that's always been very, very, very high up on my list of things to learn. And I think that for me is the most important piece of advice I would give, is like, step out of the finance textbooks. Although they're useful and important, you need to understand humans, because that's basically what you're doing. You're trying to predict what they're going to do.
I think that's why it's so interesting today, because we talk about, I like to say we really are at a turning point. And whether the turning, it's not the afternoon it's taking place. Like, it takes place over a while.
Yeah.
But we really have now, we've been at probably 15 years with zero negative rates in many parts of the world, with money printing or quantitative easing, whatever you want to call it. And, it's taken increasingly more debt to produce the same amount of economic growth, like the same dollar. And so again, like, I live close to a university. I was walking by earlier, and they're all out with their cap and gowns on and stuff like that. And I think the more that you appreciate that the economic and financial geopolitical world, it is turning, right? It happens, but because it happens so slowly, and all these things have happened in the past, then most people, they just don't recognize it. They're just up too close to it, so they're getting sort of clouded with all this day-to-day noise that's going on. But again, for anyone who's starting out or listening to this show, understand global macro, because that's going to set you apart from everyone else. Now, I also asked, I don't need 200 phone calls from eager students looking to work for me now.
That's why you have an assistant. He can screen the calls. But
I know Steve and Rich are looking to hire all.
Oh God!
Students, so
but wait, can I just touch on one more on the turning points? I just want to refine that, because I think that there's three things tangible turning points that people can go out there and learn about. That might help them, which is the three of them that I've identified. And I'm sure there's more, but the ones that I identified, which is the geopolitics. So the relative power of the US is going down, which is not absolute power, but relative. And obviously China, for a long time there, for like 20 years, there was the only one superpower, America. And now the relative importance of that country is declining. That's one major turning point. Technology is obviously a major turning point. Years ago, everybody talked about the Internet of Things or whatever, all these stupid, phrases, but it is true. I mean, that is a profound and maybe it's the fourth or fifth industrial revolution, whatever you want to call it, but that continues. Started a while ago, but it continues. And the one that I think we don't talk about enough on this show, and something that people can definitely go out and read about, it's not a complicated subject, but it is important, is the demographic change, which is the age dependency ratio. So the number of prime aged working people relative to the people who are not prime age working people. So young plus old, divided by the people in the middle, 15 to 60. That for the first time since 1960 that ratio is starting to rise. Hopefully I got the numerator and denominator right, but my point is that for 50 or 60 years, you had more and more and more prime age working people relative to young plus old. And now that number is shifting. So you have less and less and less prime age working people relative to young and old, which is going to change savings, investments. It's going to have effect on interest rates. It's going to have effect on labor and wages. Anyways, sorry, I think that's a really fascinating turning point that we don't talk enough about on this show.
Well, yeah, no, there seems to be a structural thesis that the power could be coming back into the working class in terms of demanding potentially higher wages and sort of away from corporations. But I'd love to kind of chat a little bit further, coming back kind of full circle on, Rich, you're talking about history. You have to understand people and humans and how they react. And we're at this very precarious time in history right now with, again, sort of, 30-year highs in inflation. I think we've talked about these structural shortages in commodities, and that the Fed can't pump more oil. The Fed can't, grow more wheat. And so these are issues that are sort of surfacing. And, we're already starting to see, food riots in some of these emerging market countries. And it's sad. It's kind of makes you thankful at times to be here in Canada. But I mean, there are real crises that are already breaking out. You just don't read about them or hear about them in sort of mainstream media, but there is real food problems and oil shortages in some of these emerging markets. And there's going to be a lot of pain. And, we're already starting to see now, like, how do politicians react to this? Funny enough, again, like whether you agree with it or disagree with it, like, I don't know. I think we're going to get some form of helicopter money to sort of quote unquote fight inflation. I don't know. I think it's possible.
No. Sorry. I'm just shaking my head because it's stupid.
Like, I mean, but I totally agree. I mean, like this guy obviously he's his own political party. Everybody knows what he stands for and whatnot. Like, I don't care if you like him or disagree with him, whatever. But, it's just funny. I'm just reading a tweet here from Jagmeet Singh like yesterday. And he says, Canadians woke up to see inflation at a record high again. When times are tough, people, not corporations, deserve support. Today, Parliament will vote on the NDP motion to give up to $1,000 to Canadians struggling with the high cost of living, right? Like, so they always choose the route of like least amount of pain, right? Like, let's just give people more money, which ultimately is going to make the problem even worse from an inflation standpoint. So yeah, I mean, that's kind of something I'm kind of watching very closely. I don't know if you guys have any thoughts in particular, like Keith. I mean, you love ragging on, Europe, the Eurozone. We all know it's going to a donut at some point, but how far away, how do you see them sort of grappling with where we're going? Maybe persistently higher inflation, sluggish economic growth. Do you think that helicopter money is coming again in some shape or form in Europe?
Yeah, absolutely. So I don't see any way out for the Europeans because right now I think they're creating a perfect environment to have increased domestic disagreements, if that's the nice formal way to word it, to put it. But I mean, they shot themselves in the foot now with energy agreements with the Russians and other kind of the Middle East. If the economies and climate continues to change, you're going to get millions of new migrants coming up from Africa and in the Middle East into Europe. And then that's going to put further strains on their systems. You need very strong economic growth and, to try to grow out of a debt problem, which has never, ever, ever, ever worked in the world, despite people always saying, oh yeah, you can grow out of a debt problem. But they've been trying it for 80 years and it the debt problem just gets bigger. So there you go. So yeah, so at some point, Steve, I think they are going to have some form of helicopter money. And the moment you do that, you know that, hey, the gig is really up. They're again, I just can't see how Europe can withstand this. And even now, like I know, again, like the Americans, whether it's the Treasury Department, the Fed, State Department, you name it, they're all, acutely aware of stress points around the world. And, mainstream media are telling you right now, and look at Russia and Ukraine, for example. But I know these guys are, like, even when Obama was in power, like he distinctly shifted the attention, away from the Middle East, more towards China. And then Trump came on and he continued with that shift as well. And I assume it is still happening within the Biden administration. My point is that the stress points over in China are significant. And now I'm also hearing that the stress points within Europe are now significant as well. But they're different kind of stress points, not what the Americans will be concerned with the Chinese and the Russians, in terms of a military conflict of some sort. They're concerned that, hey, we have a partner over in Europe. So what's that population for the EU? 400 million plus, I'm assuming. It's the same size as America, right? Basically, when you put it all together, for better or worse, they are allies. But I know the Americans have concerns about what's happening internally there. So from a financial perspective, I just see, a lot of dislocations coming up, and I like it because I think the way that we're positioned, we'll make money from that. And again, there's nothing we can do to prevent it because it is coming down the pipe. But we've reached this point where things will, sort of, what was that, snap, crackle, and pop maybe coming up.
I'd love to just add to that point on dislocations. Because again, not to beat a dead horse, but we've kind of been talking about this, and someone asked us, at the Loonie Hour Q&A session there, about like food prices and all this. And, natural gas prices have almost tripled. Local fertilizer prices around the globe. Diesel fuel for farm equipment is becoming unavailable. And again, this is kind of leading into this food crisis. And again, I'm really struggling to see how. Keith, we talked about like demand destruction from central banks. I'm really struggling to see how this is going to solve a lot of these issues. So, like, I just look at it and say, okay, like, again, I'm trying to sort of play devil's advocate. I think they should have raised rates maybe to contain inflation when they had more of an ability to do so. But like, so we're dealing with like record food prices, inflation, because a lot of these, supply chain issues. Again, if you can't get, gas, if you can't get diesel to mow your crops, how is raising rates going to fix that? And so now we're going to raise debt servicing payments on an over-levered private sector, and that's going to fix these issues. Like, now there's talks in the media here that people can't get baby formula. So it's like, how's the Fed going to fix baby formula? So I'm just struggling to sort of see a positive outcome here. Like obviously the goal from the Fed here and these central banks is to basically kill demand and put us into recession. But I'm struggling to sort of see how that's going to materially improve the day-to-day of everyday citizens.
Well, it won't. We'll have to hit a low point and then we'll come through the sides. It's a normal cycle. Like, economic cycles work that way. Some companies and industries will really struggle during this, and others are just going to surge. Like, they're going to eat someone else's lunch or dinner or supper, depending on where you are. And I think that's outstanding. That's just the way a market works. You need to cleanse the system. I mean, to be clear, the market should have been cleansed back in 0809.
And again in 2020.
Yeah, absolutely. If you go back to 0809, I mean, again, hindsight is normally pretty accurate. But back then, politically, they refused to let, certain groups, banks go under. Was that bad?
Let's chat about the banks.
Banks, you're not allowed to let the banks go under because, once they sit in front of you, they tell you, boy, if we go under, it's going to be horrible. But I like to use the example back then. Let's just use Canada as an example. But the Canadian banks were hurt, of course, because if you're a bank, you're levered entity. If you cannot get funding, you're over. It doesn't matter how conservative you are, or how nice your bank logo is and stuff like that. If you're shut of funding markets, you're game over. But let's just say they closed down the banking system in Canada because they all went under. Well, let's say it happens next month or whatever in Canada. And they'd stand in front of Parliament and say, you can't do that. You got to, everyone's going to lose so much money and stuff. If you let it happen and then you put up a sign the next morning and say, hey, Canada is open for new banking licenses. Who wants to line up? Who wants to apply? You're going to get trillions of dollars lined up at the door, wanting one of these licenses. You get a brand new bank, pristine balance sheet. They've learned from the lessons of the past, and off they go. And that would have happened with America, certainly with the Europeans and Britain. I mean, the British banking system, like RBS, like that's one of the biggest walking zombies in the world. But if you let economics run its course, you get the birth and then the prime age and the death of a company, and then a new one will come in. But I don't know if any political group has the appetite or the stamina, to go through that, because you can imagine the pressures that you're getting, to bail everyone out.
I think it's just so. I mean, obviously, I agree with you. My views on this are quite clear. I think that the problem for people, I think more generally, is they don't understand the mechanism by which that if a car company, let's say General Motors, goes bankrupt, what happens is the equity holders are bust. The assets are still there. The patents are still there. The marketing team is still there. And so this idea that you need to, for example, bail out company A or company B for the idea that it's like systemically important, I just think it's a misunderstanding of how bankruptcy laws work and how valuable some of the underlying assets may or may not be of that specific company. Let's say, for example, that Apple, I don't know, went bankrupt tomorrow. I mean, there would be it would be a line a mile wide of companies that were willing to, swoop in like vultures and pick apart the carcass, and all the technologies and all the things that one might hold dear with respect to company A or company B, they would be rebranded, refit, and repositioned and redeployed. And so that's what I think people don't really sort of get. If Air Canada goes bust because we don't subsidize it to some insane thing, well, I mean, trust me, there's, I'm sure, half a dozen companies in Europe and the United States that would love to overcharge Canadians to fly from Halifax to Vancouver. Do you know what I mean? And I think that in general, people have not been sort of made aware of that process. And so that's why I think there's so much political pushback, just because we don't get it. People don't get that if the company goes bankrupt, it doesn't mean that those products stop being used or they just disappear into the ether. Anyway, sorry, Steve, I don't know if you had something to add on that.
No, yeah. I mean, I was just going to say, I'm certainly not advocating for, not raising rates or anything along those lines. I just think like the system is so wound up now and everything is so interconnected because of the last 12 plus years of basically bailing out, every single entity that may or may not, go bankrupt. So we don't really have free markets. We haven't for a very, very long time. So that's kind of my prognosis. I just don't think, vis-a-vis the Bank of Canada raising rates, let's say to 300 beeps, is actually going to solve a whole lot of issues. I mean, I definitely think we need a rebalancing in the housing market. So I'm all for that. But like I talked about this, everyone's like, oh, this guy's just pumping his own book. I talked about this back during the onset of the pandemic by basically the mechanisms that they took, which was, these massive QE programs. Oh, nobody has to pay your mortgage for the next 6 months. Don't worry about it. I said, this is going to create moral hazard. right? Like,
for sure.
because we already had this 25-year bull market where everybody's like, oh my God, you cannot lose on Canadian housing. You cannot lose. Look at 2008, 2009. Did you see, like, we went through like a 6-month correction, prices dropped 10%. The rest of the world crashed, but Canadian housing is rock solid because we're just the best country and we have all these immigrants, and like, you cannot lose, and our banking system is the best. And like, so like there was this mindset that like you can't lose. And then the one time when we should have had like this like real correction, like record unemployment, like what do? They came in and they plugged the ship. And again, so you create, and it was, everyone goes, well, look, we had a pandemic, record unemployment, and like you still can't lose. And so it just created this wave of frenzy. And that's why we had national home prices ripped to all-time record highs, inflating by 26% on an annual basis. Like,
I'm not sure you're being mean enough. I think you're not being mean enough. I think that one of the things that's so, I know this is a little bit of a digression, but one of the things that's so pernicious about a policy like CERB, you know, I don't know what it stands for. Basically, people were given handouts, is that money went from the bank, the government, directly to landlords.
Yeah.
So no landlord went bankrupt. And you say, well, Rich, you know, people had to pay their rent. It's like, no, that's like, you're not understanding the second order effect, right? It's a very short-sighted way of viewing things. If I owe you $1, that's my problem. If I owe you $100 million, billion, trillion, that's your problem. And instead of saying like there's a moratorium on kicking people out, the asset holders have to take the hit. They need to draw, which is, in my view, how I would have done it. Can't kick anybody out of the house for 12 months or 24 months and they don't pay rent. And then anybody who is over leveraged and can't absorb some kind of cyclical downturn would have been bust, and those assets would have been put back into the market, and the cycle goes on and on. Instead, we were conned into believing that handing over money from the government to rich landlords was like a good policy. And I find that that's, you know, it's not enough to say, you know, there's a moral hazard. It's an outrage. You know what I mean? I don't know. That's my
I mean, it was that policy though, like the whole like mortgage deferral, I think actually like ultimately like arguably like benefited the banks the most. I mean, like at the end of the day, it's like the house is the bank's asset. Let's call a spade a spade.
Sure.
So, but Keith, I don't know. Did you also wanted to chat on Canadian banks too?
That's right. But it's a good point though you just both made, is that, you know, those programs were done to bail out the banks, right? They weren't bailing out, you know, the average guy or someone who's owned the building and stuff. It was the banks. They would have to take the hit. Before we talk about the banks and the earnings coming up next week, just something to highlight. I think people will, I'll say it and they'll go, oh, okay. So in the investment world, we're really living in the future, because it's disconnected from the economy. So if anyone listening to this are saying, man, those two young guys are crazy, and the old guy is crazier, right? But you know, in the financial world is forward-looking. Things that happen in our world, you know, on our computer screens and whatever, it takes a while to trickle into the real economy. So if you go out there now in the real economy, like everyone can get a job if you want one, like, you know, lower income households, so they are suffering trying to find housing. Of course, that's happening, but it's none of this, you know, death spiral that, you know, that is being suggested sometimes out there. So, but just so that people can appreciate, financial markets are leading, and all these turns that we see coming up, they'll be felt, you know, later on down the road, whether that's a few months or whatever. I remember a few years ago, back when the 0809 crisis was going on, one of the guys I know, he's in Toronto, and he told me he was like at one of the gyms, you know, running on a treadmill or something like that, and all of a sudden he couldn't breathe. He had to stop. He was pointing towards, but what's the thing on the wall? You know, they'll try to energize you up with the shocks and all that. What's that called?
How long kind of gym are you going to?
Yeah,
You know?
really.
Yeah.
Is this a
Free money on
nightclub
it.
that you and Mrs. Icecap go to?
No, like everyone clear. This is, to get them,
Oh,
to wake up.
EKG. No.
Yeah, there you go. Anyway, he felt like that was happening, and and when they talked him down out of it, he went home, he explained to his spouse what was happening, and she's looking at him, said, like, "What are you talking about?" He was like, "Well, look at the market and this," and of course, it took a couple of months for it to really hit. So again, like we're not that out of touch or off base here. We're just sort of looking at things through the eyes, from the financial markets. Moving over to Canadian banks, all the banks come up with earnings now starting next week. Most people are focused on, what's the earnings number? How much money are they going to make? And whereas like someone like Apple or Caterpillar, those companies, usually analysts are really good at estimating what they're going to make. Because the top line is the top line. You can measure channels, what it's going to be. Expenses are pretty easy to track as well. So there's not a lot of ways for a company to massage their numbers. And then you have banks. So one of the key things with banks, they have a bit of a, like in street talk, they have like a smoothing bank they can use. So when things are really bad, they can take, reserves out of that to smooth things over. When things are really good or extraordinarily good, they can sort of take a little bit off that and put it in, the bank to help them out. So it's called provisioning on their bad loan portfolio. So for potential bad loans, and if the bad loan, if it doesn't materialize, they can pull it back and stuff like that. So it's very highly unusual for a bank, unless they're in a crisis moment when they have to really just throw everything out. They should always beat the estimate that's coming out. So never be in shock and awe, say, holy smokes, XYZ bank, the blue shirt or red shirt or green shirt or whatever other color I missed here in Canada. Wow, they really beat earnings estimates. Like it's not that hard. Like the goal is enormous. Instead, you want to focus on what are they doing for provisioning on their loan portfolios, and what are they sort of guiding everyone going forward for lending. So those are the two key things to look for next week. And what you're going to see, their lending guidance is not bad. Like they're not seeing doom and gloom out there. They're seeing like 10% plus lending growth. That's what they'll expect. But you could see their provisioning start to increase a little bit. And that's the tell that you want to look for. So you can increase lending, but of course those lending standards have gotten more strict. So they'll charge higher rates on the loans. You may need to put more down, to get the mortgage and stuff like that. But next week for banks earnings numbers here in Canada, if you're like Rich and you're a bit geeky and nerdy and stuff, with glasses, which I've discovered a while ago. Yeah. You need to get into these numbers, and they're really fun to look at, and then you can see the behavior of the bank. So don't get, excited over the EPS number. Instead, dive into provision numbers and compare from one quarter to the previous to the next. Right, Steve?
Well, let's chat about provisioning because I won't name the bank, but there was one of the big bank economists there. It's not publicly advertised, but anyways, one of them is calling for predicting on internal discussions a 20% decline in national home prices by the end of this year. Which, I mean, even for me, I'm a little bit skeptic and can be bearish at times. I think it's a little bit on a national level. Like, do I think suburban house prices in Ontario can drop 20% by the end of the year? Sure. A national home price index 20%. I think that's a bit of a stretch in the span of the next, 7 months. But one of them's calling for that. So I'm not sure if they're calling for that on their lending as well. And Keith, like you probably won't see that in their loan loss provisions, right? Like so publicly they'll sort of put this illusion out there that, oh, everything's great. The three mortgage insurers in Canada, right? You've got CMHC, you got Sagan, you got Canada Guarantee. Their unit application in April was down 40% year over year. And that kind of almost coincides with, I think national home sales were down 20+% in April. So I think lending volume at these Canadian banks, at least on the residential mortgage lending side, should contract rather significantly.
I mean, it had to, right? I mean, sorry, just really quickly, it sort of had to, right? We were at like sort of insane record. I mean, insane numbers, right? I think it was at one point, it was like 7.8 or whatever percent of GDP was in mortgage lending, right? In 1 year. So, I mean, it's good. I mean, in a way, or sorry, Keith, go on.
I think people need to understand, appreciate the way banks are put together and structured. And it's getting better, but for years, the economics department, like it's first of all, it's not a profit center, it's a cost center. So anyone in that world, you know exactly what it means. It's what it means for a bank. It's a necessity that you need, but they don't really add any direct value to the rest of the bank. And that's because the bank isn't using their wisdom and guidance to make strategic decisions. Let's sort of walk through how that works. But instead, the economics team, you produce really cool stuff and you put it out there, and people like us will banter it around, and then it's forgotten the next day because they put out something else and again. But within the bank, because they're so large with so many different groups, like the investment team will not follow what the economics core team is saying and everything like that. For a bank, again, like you just say you're on the consumer lending side with mortgages, man, you have goals to meet. And if you don't meet your goals, you're not getting the bonio. Rich, that means bonus, by the way, Rich. Rich doesn't live in a bonus world.
No, not anymore.
Self-employed.
Many years ago.
Yeah.
Poor now.
A lot of equity in the firm. But anyway, but you want to make these numbers, so you can get a lot of disconnect with inside a bank. I mean, what's being pushed out there for an external message and what's internally. So again, like you might hear this stuff, like we'll see what you mentioned on the outside, but inside, like again, you get their earnings calls next week. That's where you can do the reconciliation, from what they're really doing, what they're not doing. Oh, by the way, I forgot to mention. So yesterday I was scheduled to have a call with the CFO of a US-based bank, and really excited. We're about to get it going. And literally 5 minutes before the call, he emailed me. He said, "Keith, something urgent came up. I can't make it." That was it. I haven't heard from him since. And
of course, is he alive?
He probably doesn't want to hear his story on the Loonie Hour.
Yeah, I don't think we have that much reach, and I assume his bank is still alive. But just to share with you, like in the E-suite level of banks these days, there's a lot of stuff going on, and like it literally is like minute by minute on how fast and quickly things are moving. So if you're at that, that CFO level at a bank and on the treasury side, on the desk, like there, again, is the opportunity is there, not only for you to go on the wrong side or the right side, but your vendors, people who you're doing business with. Like say one of your biggest clients is a hedge fund and you're lending to them and they're levered 30 to 40 to 1, something like that. And all of a sudden they got tripped up on something. Man, like that's how you get called into a meeting. And that's what the markets are doing these days. So I will reconnect with my friend at some point soon, I hope. But
that's the good.
Yeah. No, I'll never share what's happening because that's the business we're in. But again, like the anecdotal story, like there's lots of those happening these days in the industry because there's a lot of volatility going on out there.
Well, I mean, just anyways, everybody just wants to know, Keith, are we shorting the Canadian banks yet or what? Give us a scoop. Which one are we shorting? No, but in all seriousness, obviously, disclaimer, this is not financial investment advice. But yeah, I mean, I think that's kind of a good spot to wrap it up, basically. I mean, Rich, I don't know if you have any sort of final parting words.
No, just something we talked about briefly a couple of weeks ago. We talked about financial accidents or whatever. And we highlighted spreads, credit spreads. We talked about how the bond market is much, much, much larger than the equity market. And one way to sort of sniff out or identify the potential for financial accidents or crises, maybe that's crisis is too strong a word, but is to keep an eye on credit spreads. And as we sort of kind of were, alluding to, they're starting to creep higher. So what does that mean? It means so something like a high yield, let's say CCC rated bond will have a spread now of 800-900 basis points, even higher, I think in some cases, over an equivalent duration risk-free bond. Risk-free in inverted commas, of course, a government bond. And so it's just something we sort of we chatted about, teased a couple of weeks ago, maybe I think about a month ago, and just wanted to pay that off because they're starting to creep higher. So something to keep an eye on.
Done. Final teaser. The Chinese government, there's a lot brewing behind the scenes, locking down their entire country there. Working on side deals here with cheap Russian oil. And
something stinks there.
Something stinks there for sure. And now there's a piece here in the Wall Street Journal, pretty reputable rag they have there, talking about the Chinese government encouraging their citizens to repatriate their capital and their assets. More so the ones that are politically connected. I think basically because they're worried about, sanctions and kind of what happened to a lot of the Russian oligarchs, for example, right? Like, oh, your assets are in the US, seized. And so, so the Chinese government has kind of issued that statement to part of their sort of politically connected people as well. And so basically encouraging some of these families and their siblings and whatnot to basically sell some of their assets and repatriate the capital. So obviously that brings up into question parts of Canadian real estate, particularly here in Vancouver, wondering what that impact might be. So again, these are all the big macro things happening behind the scenes. There's always something happening, something going on, and that's why we put the show together every week. So we'll wrap it up there, and we appreciate everybody's ongoing support. All we ask is that you share this episode with at least one person, one family friend. Let's continue to build the Loonie Hour community. As we can clearly see from the live event, it is growing and growing at a tremendous speed. So we are deeply humbled, and we look forward to chatting again next week. See you soon.